We're here to talk about Silicon Valley real estate market, week ending January 3rd, 2025. I'm Richard Calhoun with Creekside Realty. These are the 15 key chapters that we're going to be going over. These are the corresponding graphs. There are links in the YouTube description below, so you can jump to the chapter you find most interesting for your specific needs. Here's the first data slide. It's a summary slide. It's showing inventory. And what we're doing here is we're showing the red line, which is the least amount of inventory. Red is always favoring the seller. Blue is the most inventory you'd expect favoring the buyer. The gray line is where you'd expect the inventory to be based on the previous 10-year medians. So now that we're into the new year, that would be 2015 through 2024, the 10 years, and that 10-year median is this gray line. So you can see the purple line being the data line is below, especially over here on the right-hand side, which is the current week. This is a 14-week period, the current week plus the past 13 weeks, which is a quarter. So you can see that we only have 73% of the inventory that we should have for this time of the year compared to the 10-year median. That's 881 listings. Just 13 weeks ago, we had 2,652 listings, or 91% of the inventory. So not only have we lost inventory that we do typically at this time of the year, as you can see, the gray line is going downhill, but we've also lost a percentage of the marketplace. We were only missing 10% of the marketplace back here 13 weeks ago, and today we're missing almost 30% of the marketplace. Same concept with the number of offers. You can see offers started off at 81% of the level of offers you'd expect, and then they dropped down to 74%. Their drop isn't as much as the drop in inventory. DUI is the seller-buyer balance, the supply-demand balance. You can see we started off at 100%. Basically, 100% was right on top of the gray line in a typical normal year. We've been following the gray line fairly accurately. The last couple of weeks, we have pulled down, and we're now at 89%, so 11% faster marketplace. So the turnover rate is quicker. It's taking less time to sell all the inventory if no new listings came on the marketplace. A theoretical turnover rate. A number that makes more sense is the time that it takes 75% of the sellers to sell their properties. And this number has been going up fairly significantly for Silicon Valley. And this is Silicon Valley data, which is all of Santa Clara County, Alameda County, and San Mateo County. And it is important to look at the data individually by counties and then by micro-market areas, which is what we'll be doing over the next 45 minutes. But the reason I say that is I've looked ahead at the data, making sure it's accurate or as best I can. And I've noticed Santa Clara County has really dropped down recently. So Santa Clara County is really going against this recent trend of increasing time to market the property. You can see we started off at 38 days, which was slow. It's right on top of the blue line. It was 50% almost longer than it typically takes to sell. And we're now up to 67 days, which is quite a bit longer. It's almost a doubling, but that's 74% longer than it typically does. So definitely a slower marketplace for the 75th percentile. Now, what you'll find is a large percent of the sellers come on the market and will sell right away. And that number is usually somewhere around 50%. Of course, it varies. And that's why I look at the 75th percentile, because the 50th percentile, the median, that is more common in statistical analysis, just doesn't mean anything on days on market. Price cuts. Back here, we were taking 0.8%, 0.9% basically, which sounds fairly small, but the large majority of sellers take no price reductions whatsoever. And that was 98% and 98.5% of normal. So basically right at normal. Now we're taking 1.06, somewhere about 1.1% price reductions, which is 18% more than normal. So still a pretty typical normal number. And you can see that you're pretty close to the gray line. You're not down here anywhere close to the blue line, and you are on the blue side of the gray line. Now we're looking at overbids, and this is a lagging indicator. It's on here more because it seems to have a high consumer interest, and it's the amount of overbidding that's going on. Normally the overbidding amount is 4.4%, and this is the average overbid, not the median overbid. And right now, or 13 weeks ago, we were at 5.5. So you're basically 25% higher overbid than you typically were. Come forward to current day, and the typical overbid is only 3.3%. So you can see the overbid gets lower as we get to the end of the year holidays, but now we're 4.7%. So again, that's almost 50% higher, because 50% higher would be about 1.7, and 1.7 would be 5%. So roughly you're now 50% higher instead of 25% higher. But your overbidding is running just under 5% currently on the average. And we will talk about the median later. Now we're moving on and looking at the three components. We're looking at inventory, offers accepted, and days of unsold inventory. That's the speed of the marketplace. We're going back to 2015, which is the beginning of the 10-year period that I'm using for my 10-year median. That goes all the way through the end of 2024 through 2023. We have a condensed scale from 2024 and 2025, the current year. We have a 2x scale on the date. So notice that the 1 year is much closer together than the 1 year going forward. And I do that for consistency. What you're doing now is you're plotting the three components compared to their 10-year median. For example, we'll start off on the purple line, the inventory. Purple line right now is you're basically somewhere around 72% of the inventory you'd expect to have based on the 10-year median. Then you move on to the offers accepted, and offers accepted is right there somewhere, but I think the number was higher. I think it was somewhere around 77% of the offers you'd expect. And the speed of the marketplace, the turnover ratio is 90% of where you'd expect it, which is a faster marketplace than you'd expect. And with the offers being above the inventory, that is what you'd expect, a faster turnover ratio, but you'd expect it to be closer to 100%. And the reason it doesn't work out mathematically is each one of these components is looked at individually, and the median for inventory, the median for offers accepted, and median for DUIs happen in different years. And that is why this gray line is closer to 90% instead of closer to 100%. Now we're looking at the normal components. So the purple line is your actual data. The red line down here is the least inventory you'd expect, the blue the most, and the gray is the typical. You can see we're right on the least. We're basically right at the valley for the year. Typically, you can see that starting next week, the market normally turns around and starts going up. So this is probably the low point in inventory, and it is pretty low, especially in Santa Clara County. Here's compared to normal. So if you were having a normal year, you'd be right up here at 100%. You can see that we're down here somewhere right around 72% or something like that. That's inventory for all of Silicon Valley. Here is the same concept for the number of offers accepted. Note the offers accepted is popping out below the blue line, and also note that the blue line goes down for at least a couple more weeks. And the reason for that is if inventory starts coming on next week, it's the week after that that those offers will start rolling in. So we're going to have fewer offers most likely next week, and the week after that, if inventory does increase, it will likely increase. The number of offers will start coming back up, and you can see the trend. That's the whole purpose here, is you can see that where your data is currently, you can sort of project that most likely next week will be lower. And a very good projection in this particular case would be you'd probably going to be following the blue line. Now, you don't have to be following the blue line, but that's the reasonable expectation. And then in about a week to 2 weeks, you'd expect that number to turn around and for the offers to start climbing. Now what we did here is we pulled out that curvy gray line and made it 100%. And you can see that your offers of being accepted is down here somewhere around 74% of where you'd expect the offers to be accepted. Moving on to days of unsold inventory, here is the speed of the market or the turnover ratio. And here you can see we've been basically following the gray line. Yes, there is some variation from week to week, but for the most part, you've been right on top of the gray line. We got a little bit slower here in the summer. I think it was basically something like July through the August. We were a little slower, but basically by the time we got to October, we were back. And right now, technically, we're a little bit faster than normal. Here you can see pulling out the gray line. Here you can see the slowdown over the summer. And now you can see that you're a little bit faster than normal at about 90% of the speed of the marketplace. So it's only taking 9/10 of the time it typically takes for all the inventory to be sold. This is actually sort of surprising. I'm not 100% confident in this data. I was playing around with my 75th percentile, but it was climbing before I played around with it, and I was expecting it to go up. I just wasn't expecting it to go up this much. So I do sort of question the last couple data points on here, and I will have an update on that for next week. So we're not going to spend a lot of time on it, but you can see that we are definitely slowing down. We had been slowing down last week. It seems like a jump, and I did some modifications that may have caused that accidentally not to plot correctly. And likewise here, I'm not sure. I believe this data at 175% or 180%. I guess it's actually closer to 190%. And the improvement in the last week. And I think what I did is I think I'm plotting the 83% number instead of the 75th% number, and that would give you a higher number. And I think that's what happened. Here's the 10% price reductions. So this is looking at only the largest price reductions. So instead of looking at the median or the average or the quadrants, I'm saying that if 85% of my sellers usually do no price reduction at all, typically, I'm going to completely ignore them. And in this case, I'm ignoring 90% of what the sellers are doing and only looking at the sellers that are taking the largest price reductions. And you can see that those 10% of the sellers are taking larger price reductions than they normally do. Normally, they'd be up here at about 88.5%. And instead, they're down here at about 85.5%. So they're taking significantly larger price reductions than they typically do. Here you can see it compare. If it was normal, it'd be on the gray line. You can see that we got down to normal, then we've gone up and taken bigger. Right now, we're taking something like 25% larger price reductions than we typically do. So if we typically take a 10% price reduction, we're going to be taking a 12.5% price reduction. Here's the average. And this is just to show you that, to give a metric that's closer to what people would expect. So your average price reduction is a very tight metric. It's somewhere around 1.05%. It's less than 1.1%. And that's because the vast majority of sellers do no price reduction whatsoever. Typically, you can see you're just under 1%. Here you can see compared to normal, we've been running a little bit cooler than normal, which is why we're in the blue. If you were completely normal a year, you'd be right up here on the gray line. If you had no price reductions, you'd be up here into the pink. No price reductions is pretty unrealistic, but we actually had periods of time. The biggest one was in early 2022, where on average, the sellers were actually raising their price after they went on the marketplace. You had little slivers of time before where that happened. The biggest time, and it was only lasted a quarter in 2022. But right now, sellers are taking larger price reductions. Here's compared to normal, and this is the frequency. So you can see now the frequency is basically normal. You were taking a little bit less than normal price reductions for most of the early part of fourth quarter. Here you can see the less than frequent, then more than frequent, and now we're taking less than frequent again. So there is balance, and that's why the white range here is fairly large. There's a fair amount of bounce in this data, and that's all indicating of a normal marketplace. Clearly in the second half of 2022, we were a slow marketplace, and look at where we were beginning part of 2022 when the market was on fire. You were way down at the bottom of the market. So there are times when this does indicate a slow and fast marketplace. Right now, you're sort of in the balanced range, but headed towards the seller's marketplace, and quite steeply. But you can see that this does turn abruptly from week to week. Now we're looking at the median overbid. This is a lagging indicator because we have to wait for sold price to come available. The buyers are overbidding more than typical. If it was typical, it'd be down here somewhere about 1.1%, and instead they're about 1.5%. So they're taking almost 50% larger overbidding, but 1.5% doesn't sound like a lot. And again, this is the median overbid, which is a much smaller number than the average overbid. This is the midpoint. So half the buyers are bidding 1.5% above the asking price, which means half are higher than that and half are lower than that. Here's compared to normal. You can see that we're having higher overbid than typical, but not dramatically higher. Here's the frequency of that overbidding. And again, you can see overbidding is a little more frequent. That would reach up both your average and your median overbidding. So it may be, and there's no way to know without looking at a lot more data, but it could be the frequency increase, which is increasing both the average or the median, and not the magnitude, or the magnitude could be larger and the frequency could be larger. It's typical that they're both moving in the same direction. They usually do not move independently or in opposite directions. Here you can see the frequencies being higher than normal. So you're somewhere around 5% more frequent overbidding. If you had 70% overbidding, instead of being at 70% with this 5% higher overbidding, you'd be about 73.5% of the buyers overbidding. Here's the long-term appreciation. Here I'm keeping the scale the same because you're not looking at annual cycles because the price typically goes up, but there is still an annual cycle on here. Notice the downward V at the end of every year and the upwards U sometime typically during second quarter. Very common. I think it's happened 2 out of the last 11 years and actually 3 out of the last 12, but I don't have the data up. Oh, actually I do have the data up. On this one, I'm keeping the data up all the way back to 2014. Here's the monthly payment. Here I just assume an 80% loan at the 30-year fixed mortgage rate, national average. You can obviously get a lower interest rate by going with jumbo money instead of high balance conforming money. But this gives you an idea of what the total payment would be, including an estimate for property taxes and insurance. You can see that the low price point, the cheapest 10 percentile, is more stable. The median is fairly stable, but the fluctuation here, this U, is a little more pronounced. And then when you get up to the top 90 percentile, it fluctuates more because that price point goes up and down more. And the downward trend here is mostly due to decreasing in sale price because the interest rate actually went up from last week, and yet the payments went down. Now we're moving on to the distributions for days on market. This is a little different than I've been doing in the past, but the concept's the same. The big change is I'm only going from the 50 percentile up to 90 percentile. So I'm ignoring the first 50% of the sellers that sell the quickest. And the reason for that is you can see the vast majority of the days are very close together here. So having the data from 0 to 50% really is meaningless. It's more on the upper end that the data changes. Also, you can notice there's some of these lines here, these dotted lines that are steeper. Unlike overbidding and price reductions, the shape of the days on market curve changes quite a bit more. And it basically has to do with whether the properties are not being sold at all. Like back here on 9/11, on the worst time we really had, there was basically very little inventory being sold. Basically, the United States froze and wasn't doing anything, and then it came back with a frenzy. And so there was a long period of time with nothing selling, so everything increased. Right now on the purple line, we're having a trend where a lot of properties that have been on the market are selling after a long time on the marketplace, causing the steepness, and that's basically sellers taking price reductions. But what's going to happen going forward, most likely, is this part of the purple line will drop down because the new inventory that comes on the market after the first of the year is going to be selling and has very few days on the marketplace. And that's where these dotted lines tend to be, is the steep days. The other change, instead of jumping 4 or 5 weeks initially, I jump 1 week for 6 weeks, then I jump every other week. And that's to give us more consistency. And the reason it's important, even though we're talking about data that's a year old, real estate has a very strong annual cycle. But what happened a year ago on January the 3rd is very likely the same thing that happens this January the 3rd. A year ago, you're on this dotted line right here that's bolder than all the others. And then the purple line is the current week. So you can see the current year is slower. It's taking longer for the sellers to sell their properties this year than it did last year. But when we start moving the graph going forward, we'll start from this dotted line and we'll see which way the market turns. And we'll do that right now. So there you can start seeing the dotted line. So it actually goes up for 2 weeks. And then on the third week, it starts accelerating down. And you can see how rapidly, and also the steeper slopes here. So basically that's saying that it's going to take longer for the next couple weeks, and then it's going to get really short. There's the strongest we were at, which was basically something like March the 19th. Now you can see that you're slowing down. And now on July 26th, you're sort of just in the summer doldrums where you're really not moving very much. And now right there, starting on about November 15th, you start moving up, and now you're moving up, and now you're on weekly data. And there you go. And last week, and now this week. So basically what I'm projecting based on last year's performance is we'll see this purple line move up a little bit closer to the blue line. I don't anticipate getting to the blue line, but then it will turn around and will skyrocket pretty rapidly down towards a hot marketplace. Only time will tell, but that's the typical annual cycle, and that's what I would expect to have happen. I did the same adjustments for the largest price adjustments. These are the same x-axis that I've been looking at, basically the sellers that are taking the biggest 17.5% down to 2.5%. So I'm only looking at 15% of the market instead of on the previous slide where I looked at 40% of the marketplace. Here I'm only looking at the 15%. I'm ignoring the 2.5% that are taking the biggest price reductions because a lot of times that's data input error, starting at 2.5% to 17.5% and looking at where the data is. Same concept where the purple line is the current data and the dotted line that's bold is where we were last year. So again, this year, the purple line is saying that we're taking bigger price reductions and more frequent price reductions than we did a year ago. But now let's look at the direction that we can go anticipate going from the purple line. 1 week cooler, 2 weeks cooler. Third week is actually hotter. So basically we have 2 weeks of cooler marketplace, then we're going to heat up. And again, that was right around April the 19th. Then we're cooling down, and now you're in the summer doldrums right around July the 15th. July 12th and the 26th. And you're really just bouncing around, not moving in any one direction. And now you've moved. And there you go. So very quickly you start moving, and that was right around November the 15th. And that's again, the typical annual cycle. So here's the current line on the purple, a year ago line here. So what do I expect to happen? I expect the sellers to take larger price reductions for about the next 2 to 3 weeks. And then I expect it to rapidly slow down, getting up to the hottest part right around the middle of April. Again, only time will tell, but in Silicon Valley, there's a strong repetitive annual cycle that I'm trying to make people aware of. Now we're doing the same thing on overbidding. This is a lagging indicator because we need to wait for escrows to close. That typically is a 5-week delay for the typical escrow. It is going to be shorter when the marketplace is absolutely at the hottest. And the reason for that is even buyers that are getting loans are being aggressive and pressing their mortgage broker to make their loan pre-underwritten so that they can close it more rapidly, so their offer looks more competitive compared to a cash offer that can close in a week easily. So there's a shift in the amount of that delay, but in the general part of the year, it's basically somewhere around 4 weeks. In the peak of the year, it probably gets down to about 3 weeks. Same concept. Here's the hottest, most overbidding we've ever seen up here on the red line, which was basically at the end of March of 2022. And the blue line is the least overbidding we saw, which was right after World Trade Center on November 30th of 2001. And you can see the purple line up here. So even though the previous two slides, the price reductions and days on market were both slower than the previous year, when you're looking at overbidding is actually more aggressive this year on the purple line than it was last year on the dashed line. Not significantly, but it is noteworthy that the two are different. Now let's step through and see what happens. You've got cooler, it's basically the same. So 2 weeks, 3 weeks, 4 weeks, 5 weeks is roughly the same level. And then by 6 weeks, we're hotter and much hotter. So again, what I'm expecting is to see overbidding calm down for the next couple weeks, and then for it to start skyrocketing. Then you can see it comes down to the summer, but the summer for overbidding is around August the 9th because of that 5-week lag time. So even though the market reaches its summer plateau in the middle of July, the overbidding doesn't reach its cycle until middle of August. And so here's the purple line again. So you can see the purple line is the current year data. The beige dash line is where we were a year ago. So you can see the current data is hotter. But again, I would expect the trends to follow last year's pattern, which would be a cooling off of the purple line and then a reversal and a fairly rapid increase. And again, this curve change is delayed by about 5 weeks at this time of the year compared to the days on market and the price reductions by the seller. Now what we're doing is we're looking at the 3 components individually. We're looking at San Mateo County in the orange, Santa Clara County in the blue, and Alameda County in the gray. They're all at their annual low time at this time of the year. The big takeaways are Santa Clara County is basically, when you come back here and look at it, very close to a record low. In 2022, there was less inventory. We were down here under 200. But if you come across here, we're somewhere around 275 listings right now. Last year, we were at about 300. 2023, we're way higher. The only other year that's close is back here in 2018 when we were just under 300. This is already under 300. So this is the same as 2020, 2018. So the only year that we had less inventory was 2022, and we are going to go down. I would be surprised if we reach 2022 level, but we're having the second least amount of inventory in Santa Clara County. And Alameda County is basically in the same boat, but in Alameda County, not only were you low in 2022, you were low in 2024, and you were also low in 2021. So Alameda County has more inventory. They're not at the record low. And San Mateo County is the same way, where 2022 was lower. So all 3 counties were lower in 2022, but they were also lower in 2018. So we're close to a record low, but we're not going to be a record low, as my anticipation. Here's looking at offers accepted, and even though Santa Clara had less inventory than Alameda County, it's selling essentially the same number of offers. It's a little bit less, roughly 25 fewer transactions, but same order of magnitude. So the marketplace, the turnover rate in Santa Clara County is going to be faster than it is in Alameda County. San Mateo County, it's hard to tell just because it's such a smaller county, but the number of transactions is in line with what it's been at other years. It's not a record low, but it's getting close to the 3 record lows right here in 2022, 2023, and 2024. Days on sold inventory, here's the speed of the marketplace. So Santa Clara in the blue is the fastest of the 3 counties. Then you have San Mateo County, and the slowest is Alameda County. But when I say the slowest, it would sell out all their existing inventory at the existing rate of sales with no new listings in 38 days. So to sell everything on the market in just over a month is pretty incredible. You come down to Santa Clara County, and they're doing that in 26 days, so just shy of 4 weeks. Here now is an easier to understand metric of the speed of the marketplace. It's simply how long is it taking for 3 out of the 4 sellers to sell their properties. Notice we have a significant difference here. Alameda County and San Mateo County are up here at 56 days and right on top of one another and climbing rapidly. Santa Clara had been climbing rapidly, but reversed about 2 weeks ago. And in the last 2 weeks, it's come down and is now under 30 days. So it's reversed. It's reversed earlier than it typically does. You can see the blue Santa Clara is usually reversing after the first of the year. So this is the marketing time. You can see that San Mateo County and Alameda County are very close together, essentially tied at 56 days to sell their existing inventory. And Santa Clara County is down at about 29 days. This is looking at the seller's price reductions, and this is average, so it's a very tight metric. You can see Santa Clara County is doing the least price reductions at just over 0.5%, about 0.7%, not quite. And then Alameda County in the gray and San Mateo County in the orange are taking closer to 1.25% price reductions. And again, the reason that number is so small is the vast majority of sellers that are doing no price reductions. It's only about 15% of the marketplace that's doing price reductions. Here's the ask price frequency reductions. So this is the frequency, how common is price reductions. Very uncommon in Santa Clara with only 13% of the sellers doing price reductions. The county that has the most is Alameda County, and it's only at 22%. San Mateo is coming in at 19%. Also, just in case you haven't been watching previous videos, I'm now only going back to January 1st of 2015 through January 1st of 2024. That's 9 out of my 10 years. My 10th year is 2024, which is on an expanded x-axis. This is the x-axis for 2024, and for the 2025 that we're going into is about double what it is for the previous. That way you can see all 10 years that I'm using for data, and you can see 1 year on the expanded scale. Moving on to the magnitude of overbidding, you can see all 3 counties are very close together. I would call it a 3-way tie. San Mateo County is technically the least amount of overbidding at about 4.5%. And Santa Clara County is coming in at about 4.75%, and Alameda County may be the highest at 5%, but they're all very close together. This is the average overbid. The median overbidding would be quite a bit lower, and I think it's about 1.5%, 2%, probably closer to 2%. This is the frequency of overbidding, and again, all 3 counties are in a 3-way tie for the amount of overbidding, and they're just under 60%, about 57 to 59%. Overbidding. So it's more than half the sellers in all 3 counties are getting overbidding. This is the appreciation rate. Santa Clara County has the highest appreciation rate at basically 90%. This is going back for the last 9 months of 2015. So you can come back over here. And here I went all the way back to 2014, and I kept the scale the same because there's not a repeat on the price. The price, you hope the prices always go up, and you can see the general trend is upwards. And all 3 go up roughly the same. But if you can come here to the last 9 months of 2015, you can see prices were pretty flat and pretty stable. That's what you want for your benchmark. You don't want to go in periods where they're doing all the fluctuations, because then it gets into what was the market mix at each one of those peaks and valleys. Here you have the price on log paper. You can see Alameda County is the most affordable at just under 1.2 million for the median priced home. Look at the significant decrease in San Mateo County. San Mateo County is about 1.7 million, and Santa Clara County is still over 1.8. So not only is the order reversed, the magnitude of the reversal is pretty big. It's about $125,000 looking at this graph. On regular paper, for those that prefer, you can see that the San Mateo County is right about 1.7 million, And if I was to guess, I would say that 1825 is pretty accurate for Santa Clara County. And again, Alameda County down at 1.2. Exact same information as on the other slide, just on regular paper. I also drew the lines back in time so you can see that Santa Clara County is basically at its peak, except for this little period of time in 2022 and earlier this year, where if you look at Alameda County and even San Mateo County, they're back. In fact, San Mateo County now, with the huge decrease this last week, is all the way back to the pricing they were in 2020, which is basically right after the pandemic. And, look how much Santa Clara has gone up since 2020. And that's why the appreciation rate is so much higher in Santa Clara County. Here's the estimated payments. All three are going to be in the same ratio because I'm just applying a mathematical formula to all three. I am estimating property taxes and insurance. And again, I went all the way back to 2014 because you're not expecting a seasonal annual cycle like you are on a lot of the other data. Now we're getting into the micro market data. This is what I find to be the most valuable in my professional practice working with clients. It shows you what's happening in the different areas. Like right here, you can see the San Mateo County, Redwood City area, much cooler than everywhere else. And this is cooler in inventory. So we have more inventory. We have 26% more inventory, where the rest of the valley is at a lack, whether it be 100% in Foster City, very small micro market area. But Silicon Valley overall is at 72%. Santa Clara is the one with the least amount of inventory at 63%. San Mateo at 88%, which is the most. Then Alameda County has in between at 70%. So you have 105% in Palo Alto, but you have a low of 63%. So the whole county. So it looks like you have a low of 64%. Moving on to offers. Offers you can see across the board are lacking. You're only 73% in Silicon Valley. Santa Clara County is at 71%. And then you can see the range in Santa Clara County. Nobody's above 100% in Santa Clara County. The highest number I'm seeing is 98% in Saratoga Las Gatos. Again, Foster City, a very small area, is the only area at or above 100%. You got a couple, Saratoga Las Gatos is close, but everybody else is blue, which means less offers. Alameda County is at 74%. San Mateo County is at 76%. So you're basically, 75% or less of the number of transactions that you'd expect to have. Now looking at the speed of the marketplace, you can see that San Mateo County is clearly slower than it typically is. Santa Clara County is mixed, but a lot of it is faster than normal. And Alameda County is pretty close to normal. But if you look at the number at 86.5%, that's right on the threshold, which is why there's a little hint of pink. And for these first three slides, I don't have micro market data for Alameda County, but starting with this slide, which is just the current days on unsold inventory, I do have the micro market data. So this is just the speed, not the speed relative to historical. So just what kind of speed would the sellers and buyers expect? And basically, even though we're missing 25% of the marketplace, the speed of the marketplace is still fast. The slowest area is the expensive areas in San Mateo County at 112 days, and then the coast at 90 days. But everybody else is fairly low numbers. And, you have some areas like Milpitas, Berryessa at 11 days. I saw 11 days down here in Foster City. And Foster City is all over the place typically because it's so small. But even Dublin, Castro Valley, and Livermore is at 22 days. So these are fairly fast-moving marketplaces. Here's your marketing time as measured by 3 out of 4 sellers are selling in less time. You can see the heart of Silicon Valley is red and selling in things like 9 days for Cupertino and Sunnyvale, Campbell 14 days. So 3/4 of your sellers are selling in less than 2 weeks. You go over to the coast and that same number is 153 days. So you go from 2 weeks to 22 weeks. It's still a factor of 11 difference. There's no way you can compare that data with using one number. And even up here in Oakland, you're at 77 days. So some of these numbers are fairly dramatic. And even if you were to look at county data, and try to describe Santa Clara at 29 days, and you can see the range goes anywhere from 57 days in South County to a low of 9 days in Cupertino, Sunnyvale. Even close by, Cupertino, Sunnyvale at 9, Los Altos at 38. That's not the same. The affordable areas, East Central and South San Jose at 41 days. That's a huge difference. Here's the ask price reductions. You can see again, the more affordable, little bit longer commutes are having the least amount of price reductions. The coast is having the most. Oakland's having quite a bit. The island of Alameda is having very little price reductions. In fact, it was a price increase of just over 0.5%, along with Newark, and Fremont's up to almost 2%. So it's saturated. And then you go over to sort of the outlying areas in Livermore that had been red earlier are now sort of a very faint pink. And I think what's part of what's happening as companies are pressuring employees to come back to work more frequently in each week, the desirability of Livermore has become less desirable. This is the frequency of price reductions. So how common are price reductions? Again, red favors the seller. So very infrequent price reductions. You can see there's areas of blue: South County, the coast, Hayward, and Oakland are the areas that are having price reductions more commonly. The area that's having the least: Mountain View, Milpitas, Berryessa, Fremont. A good part of the center part of the Silicon Valley is having very low price reductions. And when you look at the numbers, 4%, 6%, 7% of your sellers are reducing their price. This is the magnitude of overbidding. So even though we don't have very much price reductions, the overbidding really isn't that significant. The highest number I'm seeing real quick is down here in the city and island of Alameda and Berkeley at just under 12%, 7% in Los Altos, 8% in Cupertino, Sunnyvale. But then you also have areas like the coast where it's negative. So sellers are taking a 1.7%, almost 1.75% price reduction when the offers are coming in. So they're accepting on average less than their asking price. This is the frequency of overbidding. So again, you can see a good part of the Silicon Valley, the center part is, fairly red, which means a fairly frequent overbidding. Pleasanton has very little overbidding. In fact, it's only 20% of the sellers are getting overbids in Pleasanton. South County is at 27%. Little things that you wouldn't really expect. And if you were to look at Alameda County as a whole, it's 59%. So if you said 60% of your sellers were getting overbid in Alameda County, and then you go to Pleasanton and it's only 20%, that's not the same market. That's why, again, it's important to know what's going on in the micro market. Here's your appreciation. Again, the center part of Santa Clara County is really on fire, along with the Fremont Tri-Cities area over in Alameda County. The San Mateo County coast is pretty cool. When you look at appreciation, the San Mateo County is roughly around 60% overall. Where is overall? Only 48% appreciation. You would expect it to be higher than that when Santa Clara County is at 90. But Santa Clara County, Silicon Valley is at 74. Santa Clara County is at 90. Livermore is at 60, and San Mateo County is at 48. Again, those numbers are all over the place. They're all respectable numbers, but they're not the same magnitude. There's a doubling from San Mateo County of basically, if you made this 45, you come up to Santa Clara County, you're doubled. So you're not quite doubled, but you're close to it. And here's pricing, and you can see the more affordable areas are the areas that have been really on fire. The more expensive areas are the ones that are not doing as well. On pricing, I follow the median price, which is the middle number, but I also sandwich it with the cheapest 10 percentile in the area, as well as the most expensive 90. So in any given micro market area, you can sort of get a range of the prices that those would be available for you if you were looking to purchase or sell. Here's a summary of the slides that we went over, all the different metrics, all the different micro markets down the left-hand side. So you can pick the geographical area you're focused on and see the market conditions, or you can come over here and look at either the payments or what a lender says that you can qualify for, and come back and see what geographical areas would work for you and what those market conditions would be. Here's the numbers overall that we've been looking at: Santa Clara County, San Mateo, and Alameda individually, and Silicon Valley is combined, the different metrics down the left-hand side of the chart. This is noteworthy. Again, this is my low volume of transactions, and we had been basically very low. We had been the second worst year out of the last 25, but then we got down to the fact that we were the third worst year out of the last 25. Well, this week we're back up to the second worst year, and look at this. The worst year was last year at 943. We're at 944. This number will probably be below 943 next week because of transactions that fail. Once a transaction has failed, I don't count it. Now, with the holidays, there's the potential that there's going to be more late reporting, but I would suspect that this number is going to decrease, and we're going to actually be reporting next week or the week after that this current week was the worst year as far as volume of transactions. And that caught even me by surprise because we had been pulling up and doing better. You can see the difference here Just last week we were at 1,031 a year ago, and then you were at 1,131. So you had 100, you had 10% more transactions this last week this year than you did over 2023. Now you're equal. You've lost 10% of your market in just 1 week, and that's a little unnerving. I'm hoping that we get a lot more reported late transactions, which is possible with the holidays, but my gut feeling tells me that it's going to go the other way, and we'll be reporting record low numbers next week. So this is definitely becoming a very relevant slide again, even though it's not the easiest one to read. So we've been talking about the Silicon Valley real estate market. We will be talking about the Greater Bay Area, 13 counties and 5 regions. The blue YouTube URL takes you to the archives on YouTube. The green root URL will take you there as well. So if you want to type in less, this also becomes useful later on, because if you want to join the presentation Saturday morning at 9 a.m. live, you just type in the green root URL and the 2025. And if you want the handout, I do a PowerPoint handout of about 67 slides. You type in the green root URL, the letter H for handout, 2025-01-04 for today's date. And then for any specific episode, you type in the year, month, date code after the green root URL. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers in a transaction here in Silicon Valley. My contact information is there. I'd greatly appreciate it if you would like and subscribe to the channel. Moving on to the Greater Bay Area, these are the 5 regions we're going to talk about. We've been talking about Silicon Valley already. We have the San Francisco and Marin, called the cities. We have the North Bay, made up of 4 counties, the Central Valley of 2 counties, San Joaquin and Sacramento, and the Central Coast, Santa Cruz and Monterey. Again, we're now using 2015 through 2024 for my 10-year median. Instead of just last week, we were using 2014 through 2023. Here's the active inventory. You can see that Santa Clara County is pretty low. You can see that 2022 is lower. We have the second least inventory. So we're not a record low for Silicon Valley, but second least inventory. You can see that the North Bay and Central Valley are very close together. They're mirroring their long-term pattern of being very similar. They're not at their all-time low. They were lower in 2024 as well as in 2023. In the cities, it's close to a record low. I'd have to look at the numbers a little closer, but I think 2023 is going to be a lower number, and Central Coast is not anywhere close to its record low. Here's the number of offers accepted. Look at how Silicon Valley has really dropped down and now at 1,000 transactions. If you come back, it looks like it was less in 2024, which I'm not sure I understand. I guess I could be on a different part. We're going to be going down further. So, we're not at the bottom of the V yet. We're still on the sharp part of the side of the cliff. So that could be explained what's going on here. You can see that Central Valley is up here in the yellow, and then North Bay is hidden behind the purple right about there. And then the 2 smaller areas, the cities in the orange and the Central Coast in the blue. So all the areas are dropping down in the offers accepted, and you'd expect that for this time of the year, and you'd expect that to happen for a couple more weeks, because I look back for a 5-week period of time, and if you go back right now, you're basically in the month of December. So what that's saying is the first week in December has more transactions than the first week in January, typically. This is days unsold inventory, so the speed of the marketplace. Silicon Valley is the fastest, Central Coast is the slowest, cities is in second place, and North Bay and Central Valley are fairly close in 3rd and 4th place. Look at the climb in the days on marketing time here. Silicon Valley has shot way up, the cities has shot way up, the Central Valley has shot way up. I mean, they're all just climbing, but again, by having the previous cycles on here, you can see that that's normal for this time of the year. So we're selling off inventory because there's so little inventory on the marketplace now. We're selling, buyers are essentially desperate. So we're selling properties that have been on the market for a long period of time. And you can see, based on the past peaks, this will continue to go up for some period of time. And frankly, look at Silicon Valley. It's basically at a record high. I mean, there's no years that were anything close to this. I mean, the closest year we were was maybe down here right around 55 days. And right now you're at 67, almost 68 days. So significantly higher. The Central Coast is not at its peak. The cities is basically right at its previous peak and will continue to go up. So it will peak over Central Valley as its peak. So right now, the time for 3 out of 4 sellers to sell is longer than it has ever been at this time of the year. And this is the slowest time of the year. So you're basically at record slow times, which I think would catch a fair number of people by surprise because the market is turning over quickly, but yet the 50th percentile, the 60th percentile, the 70th percentile, those are taking longer than they have, which brings up the 75th percentile number. Here's your price reductions. Here is sort of a normal marketplace. I am defining a normal marketplace to be less than 100%. Normally, there are some price reductions. You can see that there's been periods of time when the prices in Central Valley and Silicon Valley have been above their ask price, which is pretty incredible when you think about it. But right now you can see Silicon Valley is the highest at basically 99%. Then you come down to Central Valley at about 98.3%, so 1.7% price reduction. Then you have basically a two-way tie here for North Bay and the cities at just about 2.2% price reductions. And then the one that's doing the most price reductions is the Central Coast at 3% price reductions. And again, this is the average price reduction. So it adds in all the zeros for the large number of sellers that don't do any price reductions. Here's the frequency of price reductions. So even the Central Valley that had that 3% price reductions, you can see only a third of the sellers were doing a price reduction. So that means those sellers that are doing a price reduction, on average, are taking about a 9% price reduction, which becomes fairly significant. And the reason Silicon Valley was such a small number, just basically 18%, so something like 1 in 6 sellers is doing a price reductions, which means 5 out of 6 sellers are doing no price reductions. Here's the overbidding. So you can see that the cities is outperforming Silicon Valley on the amount of overbidding, basically 5.5% versus 4.75% for Silicon Valley. And then you have a three-way tie, very close and just below 100%. I would say that North Bay is right at 100%, and then both the Central Valley and the Central Coast is 0.5% below the seller's ask price. Here's the frequency of that overbidding. Silicon Valley is the most frequent overbidding at just, right at 58%. Then the cities at 51%, the North Bay at 39%, and you basically got a two-way tie, I'll call it, with 1/3 of the sellers getting more than their asking price in the Central Valley and in the Central Coast. Here's the long-term appreciation. The cities has the least appreciation. Central Valley has the most appreciation. Right now, the Central Coast is coming in higher than Silicon Valley. Silicon Valley overall is coming in, it looks like, at 74%, and the Central Coast is coming in at 80%, and the Central Valley is coming in at 87%. So on appreciation, long-term investment, Silicon Valley is actually in third place, but that's very skewed with San Mateo County doing very poorly. If I remember the number, it was like about 47%, where Santa Clara County is at 90%. So if we plotted Santa Clara County by itself, it would be the highest out of compared to the 5 regions. It would outperform all 5 regions. Here's the median price, and you can see that cities and Silicon Valley are very close together, with the cities being slightly higher. Central Coast sort of in the middle, North Bay, and the most affordable being the Central Valley. Here's the payments, same formula. Notice how there's the least amount of fluctuation in the Central Valley, and that's a combination of a couple things. Is I think the people that are buying the Central Valley are more tied to loans, and so the loan payments impact them more than in Silicon Valley, where there's a fair amount of money being made on the stock market and startup companies and those kinds of things. Here's the metrics for the 13 counties and 5 regions. The metrics are across the top. The different regions are down the side. I have Silicon Valley as a region. I don't have the other 4 regions, but I do have the Bay Area. I think it's a garbage number, but I put it in there because the media talks about it so much. It's a garbage number in the fact that you can't use that to tell you what the marketplace is doing. And with that, we're back to the different chapters. You can jump to whatever chapter you find most interesting on the future videos. I'm not seeing any unmuted mics, so have a great week. Take care, and I'll look forward to see if we have the least number of transactions next week for this current week. Take care. Bye for now.